Welcome to another episode of the Health Coach Academy podcast. I'm your host, Omar Cumberbatch of omarcumberbatch.com. Listen, you guys got to give me credit. I searched far and wide to try to get health coaches that money in their pocket. And one of the things that I'm really excited to share with you is this concept that our guest today, Brent Kesler, is going to share with us. And man, it is a lot to discuss. There's a lot to unpack. And it's a concept that was introduced to me a couple years back by a buddy of mine. And I couldn't wrap my head around it. And I really thank Brent for really giving me a better understanding of what's going on with this. And I'm really excited to talk about it. And it's about life insurance policies. Now, anybody who's down the rabbit holes on Instagram or TikTok, they're starting to hear about this concept a lot. And I do believe we can leverage this as health coaches and really get our situations in a better order. And it is really fascinating. I don't want, that's why, guys, I didn't even put an intro jingle to this because there was just so much information that were golden nuggets that I couldn't even pick a part of this episode that was just a highlight. To be honest, the whole episode is a highlight. It's super inspirational. So please, as always, leave a rating and review on iTunes so I can get more guests like this. And I hope that you leave a message for me. I want to see if this is something that you want to hear more about. He definitely is up to the challenge of really coming back and breaking it down some more. But let's jump in the show. Hey, Brent, welcome to the show. How are you today?
Hey, Omar, great. Glad to be on today. Thanks for having me.
Oh, my pleasure. I always try to bring some new and exciting things to the health coaching world, and you are going to deliver because I've heard about this before in some capacity, and I'm just like, how could I get our health coaches to see some benefit out of this. So I hope that they do. I think even just our little conversation off air has really enlightened me, and I'm very excited to share you with the audience. So one of the fascinating facts what that I found out about you, and I'm going to let you tell your origin stories, but you were a chiropractor first,
Yeah.
correct? So you know about wellness, you know about how it's hard to get businesses off the ground. So I want to see like how you transition to being in finance, right? So let's jump into that.
Yeah, absolutely. Well, yeah, just as you say, in my former life, I was a chiropractor. I owned 5 clinics in the Kansas City area. I sold my last clinic in 2017, and most of the clinics I sold to my associate docs who I bought in and trained, and then they ended up taking over the office. Now, I have not practiced myself since like 2008, but I own the clinics, right? So I had associate docs in those clinics. And actually, this concept that I teach, the infinite banking concept, or our company is called the Money Multiplier. I've been teaching that concept since March of 2012, so a little over 13 years now. And however, I first heard about this concept in 2006. And I was actually at a chiropractic conference and I heard somebody talk about this thing about how to become your own banker, how to build, keep, and create wealth through your own debts and expenses that you already have, right? And I heard this information at this conference that I was at, and I was like, man, that sounds really, really cool, but it sounds too good to be true. And I'm sure you've seen things like that where it sounds too good to be true. Well, that was me back in 2006. So I heard all this information. I took it all in. I actually bought this book, Becoming Your Own Banker by R. Nelson Nash. And anyway, I brought that book home. I put it on my shelf and I did nothing with it. So then I go back to another chiropractic conference about 2 years later in 2008, and about 10 or 12 of my colleagues that were at that original conference are now at this new conference with me. But the only difference between them and me, Omar, is they acted up on the information they heard when they heard it originally.
Mhm.
So they were coming up to me and they were going on and on about, Brent, isn't this banking concept the most powerful thing ever to pay off your debt, to recapture, recycle your money? And they were just going on and on how they were building their wealth through using this concept. So I thought to myself, there has to be something to this, right? There's no way 10 or 12 of my colleagues are lying to me. Maybe one or two, but not 10 or 12. So I came home and I told my wife in February of 2008, I said, honey, we have to start implementing this concept in our life. And it was at that time, February of 2008, I was $984,711 in debt. That's what I owe to the third party creditors.
Wow.
Now, remember, I said I lived in Kansas, and I know $1 million will buy you a lot in Kansas. I know you live in New York and you don't get a lot just for your money in New York, right?
That's
Or
for
if you're in
sure.
California, that'll buy you a very small house. Well, how did I become in debt, almost $1 million? Well, I had my student loans from chiropractic school, which I'm sure a lot of your listeners have loans.
Mhm.
I also have okay, so like I also had the house that I lived in. At that time, I had two clinics. I had a house on the Lake of the Ozarks between St. Louis and Kansas City. And if you have a house on the lake, guess what you have to have? A boat and a wave runner, right? Yeah, man, you can't have a house on the lake without a boat and a wave runner. I'm also an airplane pilot. So, as an airplane pilot, I had to have my own airplane. So, it didn't take me a lot to become almost $1 million in debt. Well, I was able to apply this concept and I was able to pay off all that debt, Omar, in 39 months,
Wow.
3 years and 3 months. I never had to work harder. I didn't have to change my cash flow. I never took any additional risk with my money, and I never lost control of any of my money. All I did was added one step in my financial life. And I became really passionate about it. So in 2012, I started teaching this concept. And here we are 13 years later. I probably speak at about 50 to 70 live events a year. Okay, I'm not doing as many this year, didn't do as many last year just because I'm kind of slowing down. I'm age 58 now, so I'm personally slowing down a little bit. But our team still speaks at these events, and I do another 100 to 120 Zoom and podcast every year, right? So again, it's all teaching people how money actually works. That's what we're teaching is the principles of money. And as we were talking before we came on, the concept is not new. All right. So, anyway, this book, Becoming Your Own Banker by R. Nelson Nash. Now, R. Nelson Nash was my mentor. He
Mhm.
passed away about 6 years ago at age 87 years old. This is a book that totally changed my financial life. I recommend that every one of your listeners goes out and buys this book. Wherever you buy books at, get that book and add it to your wealth building library. That book changed my financial life. Now, I wrote another book about 5 years ago, maybe 6 years ago now, called Mapping Out the Millionaire Mystery. Now, that book, Omar, your listeners don't have to buy. All you do is go to our website, themoneymultiplier.com, or send me an email, Brent, B-R-E-N-T, at themoneymultiplier.com, and I'll send all of your listeners the ebook version of that book that I wrote, Mapping Out the Millionaire Mystery.
Oh, wow.
So, yeah, man, I just became passionate about it. And now I've been teaching it for a little over 13 years. We have over 17,000 clients that we work with in every state of the country, adding anywhere between 80 to 110 new clients a week. Um, and it's really at this point all word of mouth and referrals or things just from our speaking events that we do, such as I'm on here speaking, with your community, today. And I always tell people, I say, listen, take the information that I give you, because I'm going to give you a boatload of information on money and how money works. As a matter of fact, on our website, themoneymultiplier.com, I have a full 90-minute recorded presentation. It has all the downloadable attachments and examples. And again, it's all right. So all you do is go to our website, themoneymultiplier.com, click on Watch Brent Now, and I go through the whole process of how this actually works. But even after you go through and watch it, make sure you go out and Google my name or Google the Money Multiplier and go look at all the testimonials, the success stories, the case studies, the plan design. So don't go by what I tell you. I want you to listen to what our clients say about this concept and how we've helped them, throughout the years building wealth. So that's really just what we do. So my mission, Omar, is to share this concept with as many people as possible, just so they have the information. And even if you like the stuff that we share, you don't have to do it with us at the Money Multiplier. Hopefully, you will,
Mm.
since I'm the one sharing it with you, but you don't have to do it with us. You can go find someone else to do this with. The important thing is grab a hold of it. And if it makes sense to you, even if it doesn't make sense, get it figured out, get all your questions answered and get it figured out and start implementing this in your life because it will drastically change your financial situation. As a matter of fact, this concept, Omar, there's a guy named Robert Kiyosaki. He wrote a book called Rich Dad, Poor Dad.
Oh yeah, we
He
know.
also wrote another book called Second Chance. The concept that I teach, Robert Kiyosaki talks about in that book, Second Chance.
Mm.
Also, also a Tony Robbins. Tony Robbins wrote a book, Money Master the Game. In chapter 5.4 of the Tony Robbins book, the concept that I teach, Tony Robbins talks about. The problem is just when you read those books, they make it so complicated and difficult to understand and just transcribe into their own life that so they just read through it and don't really understand what in the hell they read. And if you don't understand or you have a confused mind cannot make a decision. So we break this down into a very simple, easy to use third grade level so you understand exactly what's going on. And on top of that, all of our community that actually works with us and that does this method, everybody is assigned what we call an implementation specialist, meaning that they have their own implementation specialist that will walk them through what we call the debt recovery sheet or the financial or the money multiplier map, the cash flow analysis, the gains projector, the debt blaster. There's different tools that we give you that you incorporate in your own financial life. And guess what the best part about all this is, Omar? Is by working with us, if like anybody decides they want to do this, they never write us a check for a dime. You never pay me, Brent Kesler, or our company, the Money Multiplier. See, I get paid one way only. I get paid the same way your car insurance guy or gal gets paid. For example, if you go to John Smith, the Allstate man, to buy car insurance, the check that you write is not to John Smith. You write it to Allstate, and Allstate pays John Smith a commission.
Mm.
So I get paid a commission on your policy. Oh, and I guess I forgot to mention to your community, how are we building wealth? Like the machine and the vehicle. The machine that we're using to build wealth is a whole life insurance policy in a mutual company that pays dividends. Now, I know I just lost about 30% of your viewers when I mentioned the word life insurance because people are thinking right now, I know what they're thinking. I've done this long enough. They're thinking life insurance to build wealth. That's a horrible idea. Why would I ever want to do that? Dave Ramsey and Susie Orman said that's not a good idea. Well, let me be clear. This is not any type of life insurance policy. No, no, no. This is not the life insurance policy you will go buy from your brother in law that sells life insurance. We all have a brother in law that sells life insurance. This is a specifically designed whole life insurance policy in a mutual company that is designed for high immediate cash value. One more time, high immediate cash value. So, what that means, Omar, is when you put money into the policy, you have cash value accessed immediately. And my definition of immediately is within 30 days. So, anytime from here on out you ever hear me say the word immediately, I mean within 30 days. So, that's how we get paid. So you, the customer, never pays us at all. Again, just as being an agent in every state of the country, plus we have Canadian connections as well. the insurance company pays us a commission. See, whoever you start a policy with, I don't care if it's homeowners insurance, car insurance, health insurance, life insurance, somebody gets paid a commission. Someone gets paid a commission on those.
No, definitely, and that's just the way everything works. So I'm fascinated by this because I said I did hear about this, and a lot of people do dabble online. I'm on Instagram. I see all these things, and they talk about this life insurance and how to leverage it and whatnot. But a health coach who's just starting out, they may not have a consistent income at this point. How could they leverage this, and maybe what would it look like?
Absolutely. And again, there's people in our community, they start as low as $80 a month. And our largest client, I believe, is doing 540,000 a month. So just pick a number between there to start, right? Now, the thing you have to think about it, let's say if you are on the low end of the spectrum, and again, it doesn't matter where you're at. So, and you're thinking, man, $80 a month, that seems like a lot. Well, remember, it's not necessarily a payment. Yes, it's a payment into the policy. You're paying the premium into the policy, but remember how the policy is set up. It's set up to have high immediate cash value. So that means when you put in money, you access cash value immediately within 30 days. So, yes, even though it's a payment, it's really treated more like a deposit because if it's going into an account that you control, is it all right? Is it treated more like a deposit or a payment? A deposit.
Yeah.
And have you ever made too many deposits in your bank account? Never.
No, right.
And tell me what word do you like better? Payment or deposit? And the answer is deposit. So it just takes a little bit of a mind shift. It is a paradigm shift because this is not what your parents, your grandparents, your friends, colleagues, coworkers, your financial advisors, your planners, your CPAs, your financial attorneys have taught you about money. They simply just don't know. They don't know. So I challenge every one of you that are in the sound of my voice is just to look into this concept and ask challenging questions. I mean, try to go and like kill it and kill it and kill it and say it won't work because of this and that. You won't get to that point. I've done this for so long. You will not get to that point as long as you're willing to pay yourself first. Okay. Now, pay yourself first. We've all heard that term.
Yeah.
And people say, yeah, of course I'll pay myself first, but people don't ever do it. See, what they do is they get money in, however they get money, active income, passive income, investment income. It can be a check in the mail from grandma on your birthday. You take that money and you put it into somebody else's bank. And guess what you do with it? You pay everybody else first. You pay the car people, the house people, student loans, food, travel, entertainment, taxes, charitable giving. You pay Bobby's soccer practice and Susie's piano lessons and hope there's money left over for you. You have to start paying yourself first. If you pay yourself first and then pay everybody else out of that pool that you just paid yourself first, it is a game changer in your financial life. It will totally change the way you look at money because now what's happening, Omar, is now you're able to recycle and recapture all of the money that has been going out and leaving your family forever. And an example that I go over in my presentation, I show you how you buy a car because, right, all of us buy cars at some time or another, right? So, how do you buy a car? Well, there's only one of three ways that you buy a car. You either bank finance it, you pay cash for it, or you lease it. But at the end of the day, all of the money that you pay goes to the car dealer, and the car dealer gives you the car. So they get the money, you get the car. Transaction is over. Everybody goes home happy. Well, what if there's a way by adding just one step in your financial life? Remember, I don't want you to change your cash flow. I don't want you to work harder, take risk, or lose control of your money. We're
Mhm.
simply going to add one step in your financial life. Now, what we do is we take the money, give it to the car dealer. They give us the car, so they get the money, we get the car. But because we added this one step, we're now able to recycle and recapture and get every dollar back that we paid for that car. So not only we have the car, but we also have the money. Now I know that sounds crazy, but I go through that in detail on that 90-minute presentation. Okay, so you got to watch that presentation or come out and just go to our website and go see where we're speaking, you know, at a live event somewhere. All right, and go come out and watch us live or whatnot. But again, you got to watch it. You'll kind of get it once I do it. And again, so after you watch that 90-minute presentation, here's what's going to happen. You're going to say, oh my gosh, that is incredible. I never thought about money that way, but I can totally see how that works. Or you're going to say, there's no way. That's too good to be true. That guy's got to be scamming people.
Mhm.
That's exactly the thing that I thought when I saw this the first time in '06. I didn't believe it. I
Mhm.
thought it was too good to be true. I thought it was too good to be true, but it's just people don't know. They haven't been told about this concept. I mean, if you think about it, Omar, I want you to think about all the wealthy people that you know in your life, okay? Or even just wealthy people in general. How often are they really talking to you about how they're building, keeping, and creating wealth and helping to teach you what to do? It just doesn't really happen, right?
Right.
So I don't reinvent the wheel. I just take the tools that the wealthy have been using for well over 200 years, and I'm going to and all I'm going to do is use those tools. I'm not going to reinvent the wheel. And one of my favorite quotes is by a guy named Warren Buffett. Now, I don't know when Warren Buffett said this, but I heard him say this in October of 2008. And this makes so much sense to me. And here's what Warren Buffett said: if poor people would just start doing what rich people do, they wouldn't be poor anymore. How much sense does
Mhm.
that make? So, to get back to your question, it doesn't matter where you're at on the financial spectrum. I mean, right? So, maybe you're just struggling to pay the light bill, or maybe you have or a cascade of flowing wealth coming in. It doesn't matter where you're at. The concept works the same for everybody. It works the same for the $80 a month guy as it does the $540,000 a month guy. The only difference is the amount of money that's working, not the concept, not the principles, not how you use it. It's just the amount of dollars. That's it. So never ever think, oh my gosh, there's no way I could do this, right? And
Mhm.
I hear that all the time where people say, well, I always thought you had to have quite a bit of money in order to start this concept. No,
Mhm.
you don't have to have quite a bit of money. I mean, we have children that are contributing and putting money into the policies. Obviously, the parent has to supervise. Right? The insurance company can't take money from children, but it's actually their money because, they have a job or maybe an allowance or whatever, and they start their own banking system. That's exactly what we're doing, Omar, is we're starting our own banking system so we keep control of all the wealth and there's no money being leaked out to others. It is a closed system.
Okay. So I guess my first question about it, right, would be something along the lines of I'm putting this $80 a month in to this account. You saying it's available the 30 days after.
Yeah.
What exactly is it available? Is it my $80 or is it something more than that?
Up to 92% in the first 30 days.
Okay.
And after the second year, okay, again, I should say up to 92% in the first year, right? In the second year, a higher percentage, and a third year, dollar for dollar, and every year after that, more than you put in. The oldest policy that I have, I started it in February of 2008. A few months ago in February, I put in, right, I paid for that policy premium again. So I paid, what is that? '08 to 25, like 17 years, 16, 17, 18 years of premium. For every dollar that I just put in this past February, that policy gave me like $2.63 to use.
Mm.
Every single year it goes up. It continues to go up. It's not me telling you it goes up. It is in the contract. So before you ever sign for your policy, pay for your policy, put your policy in force, you will see exactly what those numbers are. You will see exactly what the numbers are, the amount you're putting in, and what the policy growth is. And remember, anytime you use the money in the policy, anytime you use the money, because we're taking it out as policy loans, not withdrawals, policy loans, you never take your money out. No, no, no. You simply put your policy up for collateral, take a loan from the general fund of the insurance company. So, what that means is all your money is inside of the policy, compounding and growing in that tax free growth, and
Mhm.
the government is completely out of your hair.
Wow. Yeah, I've heard the concept before, like I mentioned, and
Yeah.
I think you're breaking it down, and definitely getting a little more clarity on how it goes. So, I it obviously is amazing if someone's putting over $500,000 a month. Why are they doing it? Right, right. So that you kind of made that very clear. Now, these loans have like general terms to them as far as the payback principle, and then or it's just can you have multiple loans on a
Right. Great question. Glad you asked that. Anyway, so I have 29 of these policies. I put well over $1 million a year in my own premium, and I buy at least one policy every 1 to 2 years. And the reason we buy more policies is because each policy is a contract. So let's just say, and again, I'll give you an example. My very first policy I started in 2008, I started it for $2,000 a month because I couldn't afford to pay it annually, 24,000. And honestly, I really couldn't afford to pay 2,000 a month, but I knew I had to change something in order to get out of this crap I was in, to get out of that debt cycle, that I was in, right? So anyway, the amount you start with is up to you. And so the way you can pay your premium is monthly, quarterly, twice a year, annually. And you can also always lower your premium at any time you want by at least 60% or greater. Okay. The reason we do more policies is because each policy is a contract. So when I told that policy, I said, I want to put in 2,000 a month. And even though the following year I'm like, holy crap, this is working really good. I want to double it and put in 4,000 a month. Well, I can't do it in that policy because that's not the way I set it up originally. So by putting more money into it than the amount I originally set it up for, it actually overfills it. Kind of like this glass.
Mhm.
Let's say this is a 12-ounce glass of water. I could never get 13 ounces of water in this glass. It would overfill it. Well,
Right.
that's what happens to the policy. If you overfill it, it becomes this thing called a MEC, which stands for Modified Endowment Contract. Now, the good old government came in and so they started this thing called the MEC rule in June of 1988, I believe, because all these people were putting so much money into these policies, and the government was like, "Well, shit, I'm not getting right. I'm not getting our fair share on that. All that tax-free growth. So now, when you want to put more money in, you have to start a new policy, just like you have a branch office at your bank." There's
Mhm.
not one branch, there's several branches.
Right.
Same thing with the policy. You have a branch office of your policy. Now, to answer your question on a policy loan, here's the cool thing about a loan. You never ever have to pay the policy loan back, ever. Because, see, a policy loan is simply a prepayment of your death benefit. So every policy has what we call a cash value
Mhm.
and it has a death benefit. And both of those numbers increase, okay? The cash value increases faster than the death benefit. And eventually, the cash value will equal the death benefit. And that really okay, so anyway, that means the policy endows, and that's normally at age 100 or age 121. But each year, the cash value rises, okay, and gets closer to the death benefit. But the true value of the policy is the death benefit, okay? Now, the policy loan that you're taking is a prepayment of the death benefit. So let's say you never pay back your policy loan. And a lot of people don't. They just don't pay their policy loan back. Well, now what happens at the time of your death, okay, which it's not an if, it's a when, right? So we're all guaranteed to pass, die, or graduate. We just don't know when that expiration date is. But at the time of your death, any policy loan that you have will get paid off by the death benefit because they already gave you that money while you're living. And then the additional money will go to your beneficiaries tax free. So essentially, the thing that you're doing, Omar, is you are living now off of a portion of your death benefit instead of not having any cash value in your policy, like a term policy. And then when you die, all the death benefit goes to your beneficiary, still tax free. So now what you get to do is you get to live your life and use that money, a portion of your own death benefit, instead of you leaving that to all of your ungrateful children.
Well,
Or
see,
am I the only one that has ungrateful children?
so yeah, so that's another other concept that I thought came up with. And we
Yeah.
because we have health coaches for various ages. Is there an age that we have to pay more, or we have to pay less? Almost like
No.
again, it's whatever it is, it is.
Yeah, great question. And so let me explain. So, like on these type of policies, the thing I ask you, Omer, is okay. The thing I ask you, Omar, is I never say how much death benefit do you want. I
Hmm.
say how much cash value do you want to put in. Okay. Now, depending on your age and your health, that's going to buy you X amount of death benefit. Let's just say you have somebody age 20 and somebody age 50, and they each want to put in $1,000 a month. Well, and let's assume they're in equal health. Well, of course, the age 20 will have a higher death benefit amount than age 50, but their cash value is going to be the same.
Hmm.
Their cash value is the same. So the policy cash value is not affected by age or health. It's only the death benefit. So let's just say that you had a twin brother, okay? And let's say, and obviously your twin brother is the same age as you are. And let's say you're a super preferred Olympic athlete and your twin brother is an overweight tobacco smoker. And you each put in $1,000 of cash value, $1,000 into your policy. That is the amount of premium you want to put in. Totally up to you, your choice. I'm just assuming you're going to put in $1,000. Well, you're going to have a higher death benefit than your twin brother because you're going to have a better health rating, right? So his death benefit will be lower than yours, but your cash value is going to be almost identical to the same. I mean, so close to where I mean, so the difference would be probably the change that falls out of your pockets when you sit down on the couch, you know?
Mm.
That's how close it is in cash value. So age and health, and a lot of people get wrapped up in, well, I'm too old, I'm not healthy. No, no, no. Age and health does not come into play as long as you're insurable. Now, if you're not insurable, for example, right now I am not insurable. I have some health challenges going on, and I am not insurable currently. Hopefully that'll change, and I will be insurable. But if I want to go buy policies for the last year and a half, or I'd say a year, a little more, I haven't been able to buy any new policies on my own body. But I'm still buying policies. Guess who I buy them on? My children, my spouse, any kind of like employees or partners that I have a vested interest in, grandchildren,
Mm.
right? Could be nieces or nephews, right? So even though you can't have the policy on your own body, right, because of health reasons or maybe just another reason or whatnot, you can still own and control policies on other individuals. And you are the owner. You control everything. I mean, I still to this day, I own policies on associate doctors that I sold chiropractic clinics to, or that I'm no longer associated with in any form or fashion anymore, or even docs that used to work in my clinics that I didn't sell clinics to, and I no longer have a vested interest in them. I still own and control their policies, and I will still collect the death benefit when they pass.
Wow, that's a fascinating. Oh, what's crazy is and this is where I usually get into the selfish component of the show, and I told you 30, 40 minutes, but I'll throw it out there because again, a lot of my questions we mirror what the health coach folks are interested in.
Yeah.
Does this substitute a life insurance policy, or do you have like the term life insurance, or do you have can have two policies? Is there an
Yeah,
advantage?
great question. The thing you can have is multiple policies. And so what a lot of people do is they like want life insurance to protect their family, right? They want life insurance to protect their family. And the cheapest type of life insurance to get is term insurance. Now, I will tell you that 97% of all term policies never pay out because the term expires. And so people pay all that money into the policy for that term and they expire and they never pay out because the person didn't die in that term. If the insurance company really thought you were going to die within that term, they would never issue you the policy, right? So, um, however, if something does happen and you die unexpectedly, you're going to want to have a life insurance policy. So before I ever knew about this concept, I had a policy of term insurance of $1 million. Well, after I started my first policy, okay, in 2008, the brand new policy I started, my whole life policy, did not give me $1 million of death benefit. But I wanted to protect my family, so I did not cancel that term policy until I had enough in my whole life policies to where my family would be protected, and then I canceled the term. So it really depends on the person's situation. But yeah, I mean, everybody, it doesn't matter if you work with me or don't do this method or not, everybody should probably have life insurance to protect their family and not to put them through torture, God forbid, if something happens early. Because if you think about it, especially whole life policies, Omar, a whole life insurance policy is the only insurance policy on the planet, life, house, fire, car, that's guaranteed to pay out. It's
Mhm.
guaranteed that you are going to die, pass, or graduate. You are not guaranteed to have a fire. You're not guaranteed to have a car accident. You're not guaranteed to have a health challenge, right? But you are guaranteed to die. So the only policy that will ever truly pay out to your beneficiaries is the type of insurance people bitch about the most. Isn't that crazy?
Yeah,
It's
no,
just crazy if you think about it that way. But again, I don't just talk to people about really the death benefit. I mean, it is a very important factor. In the last month, we've had three insured individuals pass away. Three of them passed away. And we had another person pass away. They actually got approved for their policy. It was all approved. All they had to do was put it in force. They were dragging their feet and they didn't put it in force. And he went out and got in a car accident and died.
mm,
If he would have just put the policy in force, it would have paid.
wow.
So you never know what can happen. Now, again, are chances high that that's going to happen? No, it's not. But it is 100% chance that you are going to die, pass, or graduate at some point of your life. And the only insurance that covers that is whole life insurance for sure. And your premiums never change. They never go up. They can go down, but they
Mm.
don't go up. See, like a term insurance policy, okay, Omar, as you know, if you buy a term insurance policy at age 20 and then you buy another one at age 40, you're like, oh my, that's a lot more expensive. And then you buy one at 60, you're like, I can't afford to buy this at 60, because it's so high. The cost is so high. Well, with whole life insurance, it's not like that at all.
That is interesting. Wow, it's very eye-opening, and
Yeah,
it's
man, there's a lot to peel back. And again, all right, so like on our website, I have that full 90-minute presentation. Plus, I have over 70 more videos that are on that. My daughter has a podcast. Her name is Hannah. She's 25 years old. She teaches this concept. She's actually written two books herself. One is called The Single Millionaire Chick. Another book she just wrote for children and money and financing, called The Companion. That book just dropped about 3 weeks ago. So she's written two books, has a podcast with over 160 episodes that she records every single week. And again, right, so maybe you and her should exchange and be guests on each other's
I was
podcasts.
just about to say, you gotta hook me up. I want,
Um,
that's great.
I heard you earlier talk about TikTok, Instagram.
Hmm.
So there's a guy that's on our is a client, and he's actually a colleague on my team now. He's joined our team. His name is Devin Burr. He has about 1 million followers on Instagram, TikTok. He's a real estate investor in Phoenix, Arizona. If you go out to TikTok, Instagram, social media, and go under Mr. Burr, MR underscore Burr, Brrrr, B and four R's, you will see, just start watching some of his stuff. He shows you how he buys all of his property, all of his real estate deals, and he uses this concept to do it. And he's using the same money over and over and over again to buy multiple properties.
Wow. Yeah.
Chris Noggle, Chris Noggle actually is a client of mine. Now he's a colleague. He wrote this book with me, Mapping Out the Millionaire Mystery. Chris Noggle, Naugle. He lives in Buffalo, New York. Go follow Chris Noggle. Go to chrisnoggle.com. Um, Go watch what Chris is doing. He puts out about 7 or 8 webinars, podcasts, YouTube. He's all over the place. chrisnoggle.com. Follow his content, watch what he does. He is a wealth of knowledge. So there's a lot of stuff that your community can do to get around the campfire, and hopefully they'll start drinking some of the Kool-Aid with this information. But it is the most powerful thing financially on this planet. There is nothing, Omar, that I have ever seen. And I've been looking now for close to 20 years, since 2006, and nobody has ever shown me a better vehicle that has these features and benefits that allows you to build, keep, and create wealth just this way. I've never seen it. And I ask people all the time, I say, if there's something better than what I'm showing you, please, please, please tell me what that is. And maybe I'll stop teaching this and start teaching what you show me. But nobody's been able to show me. And
Wow.
I ask it all the time because
Wow.
I want to learn. I want to learn, Omar. So God gave me 2 ears
Mhm.
and 1 mouth. So I'm supposed to listen as twice, right? So the thing is, I'm supposed to listen twice as much as I talk. I
Mhm.
still haven't learned that skill yet. I'm still working on it, but yeah, man. I'm a sponge. I want to know knowledge. I want to know things to make myself better.
No, absolutely. I want to say that not that I know how this works because it's one of these concepts. This whole life insurance thing, you've broken it down well, and I feel your energy and passion, and I think I got a definitely better understanding of it. So I thank you for that. The other concept that I've seen on Instagram and TikTok is this. I think they call it like when they take out a home equity loan and they basically dump their whole paycheck in there and they pay all their bills out of that. It's supposed to reduce the your housing. I said the terms of your mortgage, like you could pay it off in 3 years or some crazy stuff. Interesting concept. No clue how that works, but that's something out there. It's like if you ever seen before, I just want to noodle with that one.
Yeah. So
That's a
yeah.
fascinating
So anyway,
view.
just to give you a high level, like, and again, all right, so there's people that want to access the equity in their house to help jumpstart policy. So that happens a lot.
Oh wow.
So anyway, there's a guy on our team. His name is Joe, and we call him Joe Helock. Joe
Okay.
Helock. He is an expert of how all of this works in the home equity realm. But I'll just give you the high level. The thing that you're doing is, yes, if you have equity in your house, yes, you should be using the equity in your house because the equity does you no good. Now, I'm not saying use it to go start a policy, but you should be using it, to like either fund your lifestyle, make your investments, or do whatever because it's really cheap money that you can get. And because anyway, the equity in your house does you no good other than giving you the peace of mind knowing that you have equity. Because if you're not using the equity, somebody else, the bank, is using that equity in your house, right?
Mhm.
So there are some of let's see what word I'm using, like an audio or videos that we go in how to use the HELOC and how to combine it with using the policy. And yeah, so we have people on our team that are very good at that. But even if you hate the policy idea, I strongly encourage you, especially if you're disciplined with money, use your home equity line to fund your deals and make more money. For example, investments. Like I'm a lender. Okay. I'm a lender. I lend money, right? That's what I do. I mean, that's my kind of side gig. I
Mhm.
do a lot of lending to real estate developers. Um, I'll just give you an example of the house that I live in right here in Port Orange, Florida. I don't know if I said it, but I live about an hour east of Orlando next to Daytona Beach in Port Orange. And I'm a pilot. I live in a fly-in community. We all have hangars attached to our homes. We
Mhm.
have an airport runway right here, right? Because I'm into aviation. Well, this house that I live in, it's worth about $2.3 million. Okay. So a couple years ago, I called up a banker that I'd banked with forever, and Charlie is his name. And I said, Charlie, I said, look, I said, I've got all this equity in my house. What could I do to take out a HELOC? What kind of deals you got right now?
Mhm.
Well, at the time, he said, well, Brent, I can give you $1,560,000 at 2.875%, and that can be an interest only loan for 10 years. And I said, how fast do I get that before you change your mind? I want to take advantage of that opportunity. So that's what I did. So I took the 1.5 million. I took that money. I now pay the bank every month, interest only, which I think is $3,700 a month. Interest only on 1,560 at 2.875 is, I think interest. I think it's either 3,700 or 3,400 a month. So I pay that every month. But guess what I did with the 1.5? I took it and put it into another deal. Now, I ran it through the policy first, which is an added bonus, but I'm just making believe that maybe your listeners don't even want to do the policy. If
Mhm.
they do, it only makes it better. But again, here's what I did. I took the 1.5. I have a developer. I have his name is Rob. He's a real estate developer in Utah, and he develops real estate around the country. I got a project in Colorado, a project in a real estate development in Georgia, over in Covington Creek, Georgia. And he says, I'm developing this property and I'll put you in first lien position on X amount of these houses for the 1.5 million, and I'll pay you 16% interest.
Mhm.
So interest, all right, I get on that is about $20,000 a month. Okay, 16% on 1.5 million. As a matter of fact, on 1 million, it's 13,333. So it's 13,333 plus 6667, whatever that number is. I think it's 20 grand.
Mhm.
Okay. So every month I get a check for $20,000, but I got to send to bank, which is a Stiefel bank, $3,700. Do I give a crap about sending $3,700 to that bank?
Nope.
No, not at all. 20 coming in. And then if he decides to pay it off early, I'll just roll it into another loan. I have about $11 million loaned out on deals just like that. That's just one of them, right? But if he decides to pay it off, I'll roll that money into another deal, right? Because I'm not going to give up 2.875%. I
Right.
mean, I'm just sad that I'm already like 2, 3 years into that deal. I might even be 4 years into it now. I kind of lose track of time, you know. But at the time that that note comes due, like that, okay, the home equity is due in 10 years from the day that I started it. Now, what I'll do is I'll get a new home equity line of credit, and chances are it won't be at 2.8. It'll be a higher interest rate, but it's not going to be 16. I can tell you that,
Right. Right.
you
Right.
know.
Mhm.
But I'll have to roll it into a new one, or I can just pay it off. I can just pay it off. I can say, hey, go ahead. I'm all ready to get paid back my principal. It was great. I earned the 16% for 10 years. Now it's done. It's over. You know, I always say pigs get fat and hogs get slaughtered. I don't need to be a hog. I just want to be a pig. I want to get fat. I don't need to get slaughtered,
Right. Right.
right? So, I mean, the options are there. I have all of those options. So that's how I personally use the equity in my primary residence. I also have a house in Idaho. I have two houses in the Lake of the Ozarks in Missouri. I have a few properties over on Captiva Island on the west coast of Florida, Sanibel. I have short-term rentals, long-term rentals, Airbnbs, VRBOs, right? So there's lots of projects going on. There's lots of things going on to make you more money. But when you can add the policy in the mix of that and you can just have that one extra step, just one additional step, have your money flow through there first, you're now making money on top of your money because you're earning uninterrupted compound interest, which is a powerful thing. Now, up to a couple years ago, I don't know where I'm at now, but anyway, I remember when I was talking a lot, so my viewers would go out and Google uninterrupted compound interest, and I would be on the first page of that. I don't think I'm on the first page anymore, but I'm probably on page two or three when you Google uninterrupted compound interest.
Wow. Listen, Brent, you blowing my mind. I'm going to look at the video. I'm going to keep up with all the good stuff you're doing. So I know that you dropped how to get in touch with you earlier on in the show, but just
Yeah.
to wrap, if you could do that. And yeah, this was a great show. I'm glad
Yeah.
that.
So anyway, the best way to get a hold of me is Brent at themoneymultiplier.com, Brent, the at sign, the the word moneymultiplier.com, Brent at themoneymultiplier.com. Or two, the thing you can go to our website, themoneymultiplier.com. Click on the video, watch Brent now. You'll see all kind of things on there. My daughter has the Money Multiplier podcast. I told you about Burr. Go to Mr. underscore Burr on social media. Go follow chrisnoggle.com. There's one more I'll give you. I have two guys on my team, Jonah and Jeremiah. They have the Banking Bros, BROS. They're two black guys from Greenville, South Carolina. I guess maybe that's why they call themselves the Banking Bros, but they've been with me for years. They're a part of our team. They have a lot of great content to follow too. Jonah and Jeremiah do, they're brothers. Great content to follow. So lots of resources. Go Google the Money Multiplier. Go Google my name, Brent Kesler with one S, Kesler. And guys, look, yeah, I hope you reach out to us on our team, and I hope you want to work with us at the Money Multiplier. But even if you don't, just get this information just for yourself. You need to get it in front of your family, your friend, your coworkers, your colleagues. And if you think anything I'm telling you is a lie, call me out on it and challenge me. Challenge me publicly on anything I'm saying. Because if I'm saying something that's not accurate or the truth, I want to be told and I want to be corrected. And I'll be the first one to say, oh, I said that and that was wrong. But I'm telling you, I eat, live, and breathe this stuff. I do this every day of my life. And I just have this stuff dialed in. I don't know a lot about too much, but I know about this method and this concept. So I encourage your community to dig into this and, just to see, okay, what is going on. Don't put it on the back burner because time will get away from you. Don't give me an excuse that says I don't have 90 minutes to watch a 90-minute video. Well, the same person that says that is the same person that is watching Sports Center every day or watching an episode of The Bachelor or The Voice or is going to their kids' football practice every day. You can skip a football practice every now and then to gain knowledge on financial knowledge and to better your family for generations to come. So don't give me excuses that you don't have time. That would be like me saying, you know what? I don't have time to exercise and keep care of my body and work out and lift weights and eat right. That's a piss poor excuse. So if you're doing that, and a lot of the listeners will, they do it. I'm just going to call them out on it. Don't do it. Don't do that, right? The thing, especially if you have a family, you need to think about not yourself, but your spouse, your children, grandchildren, and future generations to come. And all we're going to do is we're going to practice the principles that the wealthy have used for well over 200 years.
Wow. Awesome, Brent. Appreciate you going on the show and dropping all this wisdom, sharing all those resources too. So thanks again. I hope you enjoy the rest of your day, and we're going to be definitely looking into a lot of the stuff you're doing. So appreciate you, brother.
Omar, thank you for having me on. I know you have lots of choices of guests, so I'm greatly honored that you allowed me to share today. Thank you for that.
So, my pleasure. All right. Have a great rest of the day.
All right.
Hope you enjoyed listening to today's episode of the Health Coach Academy podcast. If you did, jump over to iTunes and leave a rating and or review. It goes a long way in helping get this message out to our fellow health coaches and people in our industry. Also, if you can, jump over to my website, omarcumberbatch.com, where I give out a lot of freebies, including my 5-day sugar challenge for people who are having issues with sugar. And also for health coaches, I have the book, Hidden. It's the 6 not so obvious ways to get your clients unstuck. Have a great day.